Welcome to The Explainer. Today, we're digging into a real head-scratcher that's been on every investor's mind. How did one of India's most legendary companies, a true wealth creator, suddenly just stop? We're talking about Asian Paints, and this is the story of a champion facing the fight of its life.
So let's get right to it. Here's the big paradox we're going to unpack. How does a company that literally became a household name, whose products are on the walls of millions of our homes, go from being a miracle stock to delivering basically nothing for 5 straight years?
I mean, just look at this number. For 2 whole decades, from 2000 to 2020, Asian Paints was an absolute beast. If you had invested, your money would have grown 150 times over. It was the kind of stock people dream about, the definition of a wealth-creating machine. But then, poof. For the last 5 years, all of that incredible momentum, gone. If you bought the stock 5 years ago thinking the magic would continue, well, you've seen pretty much zero returns. The price today is right back where you started. So what on earth happened?
To really get what's going on here, we need to talk about a classic and often very expensive mistake that investors make. And honestly, it's a lesson that's way bigger than just one company. It all boils down to one critical number.
All right, the key to unlocking this whole mystery is something called the PE ratio, or price to earnings. You can think of it as the market's hype meter for a stock. A super high PE means investors are betting on a spectacular future. They're paying a huge premium today for tomorrow's growth. And this is where things get really weird. Check this out. In the first decade, the company's profits grew an incredible 7.5 times. But the market was kind of cautious, the PE only doubled. But then, in the next decade, when profit growth actually slowed down, that's when the market fell head over heels in love, tripling the PE to almost 100. So get this. People paid the highest price when the future was looking less rosy, not more. And that right there brings us to this perfect quote. See, when a stock is priced for perfection with a PE of 100, there's absolutely no room for error. The second the market got spooked about new competition, that inflated price tag just couldn't be justified anymore. It proves that even an amazing company like Asian Paints can be a terrible investment if you pay way too much for it. So you've got this stock that's already under massive pressure from its own high valuation. And right at that moment, a new challenger walks into the ring. And we're not talking about some small timer. This was a heavyweight with seriously deep pockets, and it created the perfect storm of fear. Let's set the scene here. Before all this drama, Asian Paints was the undisputed king of the castle, commanding over half the entire market. You had Burger Paints as a solid number 2, but really, this was Asian Paints' kingdom. It was a pretty stable situation. And then, bam, February 2024 hits and everything gets turned upside down. Grasim Industries, a part of the giant Birla group, launches its own paint brand, Birla Opus. And they didn't just dip their toes in, they did a cannonball, backed by a mind-blowing 10,000 crore rupee war chest. You can probably guess what happened next. The market completely freaked out. The biggest fear? A brutal price war that would destroy profits for everyone. And just like that, Asian Paints stock plunged almost 16%. The narrative changed overnight.
But hold on. Just when everyone was getting ready to write the champion's obituary, just when it looked like the giant was about to fall, the story took a wild turn. The empire decided to strike back. All of a sudden, the challengers started to, stumble. The CEO who led the big launch was suddenly out. The incredible growth in their dealer network started to slow down. And, dealers started going back to Asian Paints, complaining that the margins on the new products just weren't as good. Then, an unexpected sales drop. The cracks were starting to show.
So while all that was happening with the new guy, what about our champion, Asian Paints? Oh, they were just busy posting a jaw-dropping 43% surge in their net profit. A huge statement. And this wasn't some accounting trick. We're talking real, solid growth. They were selling more paint, a lot more. Volume growth was up nearly 11%. It was a clear signal to the market that they could handle the heat. So what's the bottom line here? That big, scary price war that everyone was terrified of, it kind of fizzled out. This note from Nomura sums it up perfectly. They found that, sure, things got more competitive, but it didn't really wreck the company's margins. The champion held its ground. Okay, so Asian Paints dodged a huge bullet. That's a massive win. But
The war isn't won yet, not by a long shot. To really see the whole picture, we need to look at two other big challenges still on the horizon.
First up, let's talk about their old rival, burger paints. Now, look at this table. Asian paints is way bigger, sure, but there's one number here that really jumps out for cautious investors, and that's promoter pledge. See that 0 for burger and that nearly 9% for Asian paints? That's a big deal for some people. So what on earth is a promoter pledge? Well, think of it this way. The founders are using their own shares in the company as collateral to get a loan for something else. Why is it a red flag? Because if the stock price drops, the bank could sell those shares to get their money back, which would push the price down even further. Burger's clean slate on this is a big plus in the eyes of risk-averse investors.
All right, challenge number 2. This one has nothing to do with competitors at all. It's a global problem that's completely out of their hands.
We're talking about crude oil. Yep, the stuff that powers our cars. Well, it turns out a big chunk, about a quarter to a third, of what goes into making paint comes directly from crude oil. So when oil prices go up, so do their costs.
And since oil prices have been going through the roof lately, you know what that means? It's going to hurt their bottom line a lot. Analysts are already predicting a pretty significant hit to their profit margins in the next quarter because of these high costs.
Okay, so let's put all the pieces together. What a story, right? We've got a champion that got caught in a valuation trap, then brilliantly fought off a massive new challenger, only to now face new headwinds from a steady rival and the crazy world of global oil prices.
And all of this leaves us with a really tough question, especially if you're an investor. What do you bet on? The dominant champion that has proven its strength but still has some question marks, or the smaller, steadier rival with a cleaner financial sheet? The story of Asian paints is the perfect reminder that in investing, yesterday's hero isn't guaranteed to win tomorrow's battle.